This might be the worst report we have seen in quite some time. It talks about the high mortgage rates. It talks about the price drops. It talks about billion-dollar deals being canceled. So on that great news, let's get right to it, right? So for one thing, we should start off with the housing market is very lagged compared to the stock market, right? The reports that just came out for Q3 of the third largest construction company in the U.S. Their reports for this quarter see conditions that existed in 2021 and the first couple months of 2022. So the lag is substantial. The lag is almost a whole year. It's 6 to 12 months. And that's why it's really important when we go to look at this data, we have that 6 to 12 month outlook. So to get us started, right? Earlier this year, we saw a favorable environment. Of course, lower interest rates, housing prices lower and starting to rise. Now we are in a more challenging market, and prices are starting to reflect that. Okay. One big thing, third quarter order and cancellation rates showed the more challenging market dynamics we are operating under today. Okay. We saw some softness in July. We saw the housing market correct a little bit when interest rates went down and mortgage rates went down. And we saw the stock market recover a little bit, and people thought it was the end until the Fed came out and released more inflation data. So this caused a pullback in demand that was widespread and very large because people could no longer afford a home, right? If you used to be able to afford a $500,000 home with a 4% mortgage rate, and now the mortgage rates are 7.5, you're getting priced down to 350. So people are getting priced down. People can no longer afford to buy a home. People are unsure if buying a home right now is a good time. And then we are seeing cancellation rates at 24% this quarter, opposed to 10% last year at this quarter. And this all has to do with Fed interest rates, inflation, mortgage rates, possible recession. And so we will go over that, right? And so the only thing that can be done right now is aggressive discounting and price reduction, right? That's the only thing that they can do. We are in difficult times, and the funny part is, it looks like it's just getting started. So, housing is the front and center in the Federal Reserve's battle against inflation, as the Fed clearly desires new home sales rates and selling prices are in the process of adjusting lower in response to higher interest rates. So, the housing inflation is the forefront to the Fed's battle, right? We have seen this lag, and now as goods inflation starts to come down, services and housing is starting to go up. So it's a whole other battle we have to get to, and this is leading to some drastic changes in how businesses are run. For starters, we canceled an agreement for approximately 19,000 lots or $800 million in future acquisitions, right? An almost $1 billion deal getting canceled because of the current housing conditions. That's not something to take lightly here. So these people are good at what they do, you might say. And when they walk away from $800 million in future lot acquisitions, you know something's up. So let's see why they did that. Home buyer demand clearly moved lower as the third quarter progressed due to inflation rates, fear of recession, or increasing concerns about job loss. Huge economic factors. And we start to see inflation tip down a little bit. Fear of recession is starting to actually increase, unfortunately. And with recession comes job loss. Now, they are taking a defensive posture for at least the near term, which means walking away from 800 million in acquisition, 19,000 lots. So their defensive posture looks a little different from our defensive posture. That might mean we save a little more money. We don't purchase that real estate property yet, or that real estate investment property yet, or we don't buy a new home for our family, right? doesn't look like it's the time to buy it. But unfortunately, we are seeing this news right here. Orders among first-time buyers increased 3% over the prior year, right? So first-time buyers normally put down 3 to 5% down payments. That's kind of how they did this. And it's increased. Right now, it is increasing, opposed to orders from move-up buyers being decreased by 45%. So people who have lived through the potential 2008 crash, or people who have more money, more experience, or are buying a second home, buying an investment property, they drop by 45%, opposed to first-time buyers increasing by 3%, even during the high mortgage rates, even during the high prices. It's because they have no other option. They could have got potentially outcharged for their rent, right? With rent prices increasing so dramatically, they might have thought maybe it's a better time to buy. And unfortunately, it doesn't look like it is. But that is what the numbers are telling us, right? 3% increase year over the prior year. Now, a very interesting thing that this company has done here, and something that is overall different with real estate companies, is their stock price and their stock trade may not affect the actual company's uh, value or performance, because they can do something like this. Opposed to spending that 800 million in future lots, they have been aggressively repurchasing shares, right? They added on another 2% of outstanding shares for a total of 9% in the total year. They have done a 9% share buyback this year, which is frankly quite a lot, and should tell you that they've seen this coming. They've been putting money back into their stock, opposed to putting it into real estate from the first month of 2022, which is interesting because of this next thing right here. They say we are currently expect that our land spend will drop materially next year. And that next year part is key, right? Because that means it's not this year, it is next year, it's in the future. So they're taking action now. They just started taking action. So although they were doing a share buyback, they just now actually started taking action now. And they expect things to start downturning now. Even though we seems like we've been dealing with this for a whole year, for real estate, it looks like it's just starting due to that 6 to 12-month lag that we see in the real estate market. Now, long term, next couple of years, everyone needs a home. People will remain needing a home, so housing demand is high long term. But they expect the upcoming quarters will be difficult for the industry. Upcoming quarters. That could be through 2024. That could be the start of 2024, right? And it has to do a lot with the Federal Reserve. If they were to pause rates, if the stock market would stop being so volatile, that might give consumers some confidence to get back in the market. Now, this sentiment thing, this psychology, the price of one's home is the biggest leading sentiment indicator that Americans have. When they see that Zillow estimate and they see it's down from last month, it's very discouraging. Even more discouraging than seeing their stock portfolio down, because the difference is they might not have $380,000 sitting in stock, but their home may be worth $380,000. And so we need this mesh. This mesh happens. This mesh occurs when housing prices start to go back up. Then people start putting, an extra $100 a month into their stock, into their retirement account, and sort of vice versa. But housing is often the leader. Housing is often the main thing people look at when kind of determining their net worth. And so, yeah, we could, if we need to see stocks go up, we need to see housing go back up for both of them to go back up, essentially, right? They react to each other. And so once we start to see one of them start increase, we should see both of them increase. Now, what levels are we kind of looking for here? They see that when they were providing interest rates between 5 and 4%, they were getting a lot of traction with customers. But now, of course, rates being at 7.5%, they're having a lot less luck, which makes sense and accounts for the new $800,000 deal just being canceled. So if we can get back to those sub 5, sub 4 mortgage rates, that's when we should start seeing traction in the housing market. But we're not there yet. The conditions are not there yet. So what's required? Price rollbacks and price drops. And so we haven't really started yet. And that's kind of now just getting put into the market. That's just now getting priced into the market, right? And so let's just say when it starts going back up, what should you look for, essentially, if you want an investment property, if you want maybe cheap housing or a house that will increase in value over time? Well, what they're looking at here is really attractive job growth in warm, attractive climates, right? Which is in the Sun Belt, the Southeast. And so if we can see this job growth, if we can see warm weather, right? They don't need to worry about cold and snow and having to have fires, gaslit fires in their house. That's where people are starting to invest in. And so that could be something you look at. Is maybe investing in a property in the Sun Belt area. Now, it doesn't look like they're doing it yet. It doesn't look like you should do it yet. But when it's time, that might be a place to consider. Okay, well, thank you for today. Thank you for watching, and I'll see you next time.